Week. Julian Emanuel is Evercore ISI Senior Managing Director. He joins us now. And Julian, thank you for being here with us. Obviously, this afternoon, the president says, look, it's still on the table. It's going to go forward. You don't know the full details, but we know at least that today. How do you think that plays out into what the market will react?
Well,
react?
What you saw this afternoon is what you should probably have seen, given the fact that we've gone from this paradigm a week ago where high valuation, high momentum, high volatility stocks were just fine. And then the news changed, right? We got some challenging news on the economic front with the PMIs lower than expected. The inflation and the inflation expectation news has been higher than expected. And you put that all together, and that's the kind of thing in a market that in general is at the upper end of its valuation range is going to cause a setback. And so for us, ultimately, we think that the story of 2025 will be written in terms of good earnings, right? But at these valuations, when you get adverse news, you're going to get the volatility that ultimately we think is a buying opportunity.
You do. So How long do you think that we're going to see this volatility before things settle out and then again end up moving higher?
Well, if you tell me what we're doing with Canada and Mexico, and I'll tell you how long the volatility is going to last. No, I think if you think about it, right, the month of March has a lot of obstacles to overcome, okay? You're going to have Canada and Mexico. You're going to have the government potentially shutting down or not on March the 14th. And clearly, based on the dialogue that you heard today with Trump and Macron, you're likely going to have something more in terms of Russia and Ukraine that we'll just see how it gets interpreted. But again, going back to this idea that the economic news has gotten unexpectedly soft, the market, in our mind, is vulnerable. We'd call it down to 5,700, which essentially is where it was on Election Day.
Is that about 10%?
A little less.
Yeah, okay.
So, and just one other point here is that actually, when you think about it, that might get some people a little bit unnerved. But actually, when you look at the average non-recession year, the average drawdown in a non-recession year is 13%. So you can make the case that this is going to be healthy as long as the economy stays steady, which we think it does, and earnings come in the way we think it will.
NASDAQ is now negative for the year here today. Do you think that the Magnificent Seven and the tech trade in general is over for some period of time?
No, we don't, actually. We're not going to go out on a limb because given all the noise, Wednesday afternoon's report, if you look at the history
Nvidia.
of how that stock has reported, the reactions have been very variable, whether the news is either great or super spectacular. And the stock has run higher over the last couple of weeks. But from our point of view, bull markets end when you either get gross overvaluation, which we don't have right now, the Fed killing the market, which the Fed is not hiking under any circumstance this year, or a turn down in the economy, which, as I said, the data's gotten weak, but we don't see a discrete turn down.
Julian, so first of all, congrats, because I think at Evercore, you guys have had a lot of leadership, both in terms of the strategy and the technical call on the markets for a while. So good for that. But when I hear growth scare, I don't hear 2.5% or 3% down on the markets. I mean, a growth scare is something this market is not priced for. You've written a report that talks a little bit about places to be defensive, those companies that might be in a high volatility environment, low volatility stocks, more buybacks, et cetera. Talk about one or two of those names.
Well, the iconic maker of mobile phones, the highest value stock on the planet. Basically, when you think about what investors are going to pay for in an environment where there's a lot of uncertainty on the macro front, you want a company that's dampening its own volatility by buying back shares, okay? And the idea of it buying back its own shares causes the volatility of that name to be low. And why can you buy back your shares? Because you're throwing off huge amounts of free cash flow.
Sounds like Apple. Well, you hadn't named it yet. I mean, come on, it was time.
Sounds like it. But there are a number of those companies across all industries, and a lot of them, frankly, in a momentum-driven market, have lagged over the last 6 months.